All right, good morning, everyone. Welcome to Maner Costerisan's estate planning webinar, Securing Your Financial Future. Today, we will be sharing essential estate planning topics, including crisis plan and document review, shifting your focus to wealth transfer, determining your estate's financial snapshot, and understanding your net worth. A few housekeeping items. This session is being recorded and everyone is muted. If you have any questions, please type them in the chat. We will have some time at the end to answer them. With that out of the way, I would like to welcome Jen Danko and Kevin Todd to today's session. Jen is a principal in the tax department and has more than 12 years of tax experience. She provides estate, trust, and tax consulting services to high net worth individuals and business owners and works closely with our firm's wealth management division. Kevin is a manager in the tax department with more than 13 years of experience. He works closely with our for-profit organizations and provides representation for federal, state, and local tax controversies. So thank you both for taking the time to share your knowledge today. Kevin, I'll go ahead and turn it over to you.
Thanks, Sydney. Today we're going to be talking about crisis plans, document reviews, when we want to shift our focus from where we were to where we're going to be. We're going to talk about your estate's financial snapshot, how to get a handle on where you're at and what that means, understanding your net worth, and we're also going to talk about legislative changes that affect all of this. So let's get started. So every estate needs a plan, whether that's something that was set up 20 or 30 years ago, or it's something that needs to happen today. There needs to be a written plan for a lot of different reasons. So a lot of people will look to a milestone event. They'll say, I don't need anything. It's just me. It's just my spouse. But then a child comes into play, some other major life event happens, such as a marriage or divorce, or someone passes away, whether it's in your generation, a generation above or below, that make you think about these kinds of things. So once you have that plan in place, it needs to be a living document. You need to make sure that you're reviewing it regularly for changes in your financial status, if there's a large promotion or a significant job change. As you're getting closer to retirement, you want to make sure that your plan fits your needs as you see them going forward. Large inheritances can also make a significant change in a financial picture. Another concern is beneficiaries. So if you have that estate plan that you set up, or trust that you set up 20 or 30 years ago, sometimes plans can change as your children grow older and they develop into their own person and they have their own life that they proceed on. When you set up that trust and that plan back in the day, maybe you were just worried about, well, what if something happens to us? Who's going to take care of little Sally? And that's all you were worried about at that time. But now Sally is 30, 35 years old and has her own thing going on. You want to make sure that when you review the plan, you take into account things like, well, if Sally is supposed to receive a significant amount of funds from the trust at 35, do we really trust her with that kind of money? Are there things going on in her life that we want to make sure that, one, the assets are protected from, but also that she's protected from? Is Sally in a profession with legal risks? Is there a lot of exposure based on what she does for a living? Are there marital problems? Is Sally married to someone that it's not quite going to work out? And we want to make sure that we are protecting Sally's future by making a change in our plan today. There can be changes in what our goals are for wealth transfer. Do we want to leave everything to our beneficiaries? Is there a new passion project that we're involved in that we can support a charity and make those kinds of changes? And as I mentioned in the intro, there are some legislative changes that affect all of this that we'll talk about towards the end of the webinar. So when you set up your plan, many people set this up with a child-centric planning focus. Like I said, who's going to take care of Sally if something happens to us, right? So we want to make sure that when we're looking at the plan, we need an idea of where we're at. So as CPAs, one of our favorite things is balance sheets. We want to make sure that we have all of our assets listed so that we have a good picture of our financial health. We also want to make sure that we have our liabilities. We want to know what claims there are against those assets, right? We'll dig into that a little bit more in a minute. So one of the biggest pieces of estate planning, and Jen can attest to this with her experience, and it's something that I've seen with my experience, have we taken that second step to really make sure that we have done everything we're supposed to? A lot of people will meet with the attorney to draft their documents and sign papers, and then they say, no, we're done. That's not it, unfortunately. You want to make sure that you're regularly reviewing your plan with your advisors, with your accountant, with your attorney, with your financial advisor, to make sure that as your goals change, so does your plan. But the other piece of this is making sure that you retitle assets in the name of the trust, or what other what other entity is out there. So what does that mean? Well, I have bank accounts in my name. Trust out there. If I don't go to the bank and say, I have a trust now, and these bank accounts need to be placed in the name of the trust, then those bank accounts are not part of that trust. So that brings up issues down the road when I pass away, because things like probate can get involved. In the big picture, a trust is a conduit. That's what it's there for. It directs the disposition of our assets, to use the fancy terms. Well, what does that mean? It means that when I pass away, or whatever triggering event that the trust is there to handle, it says that these assets go here, these assets go here, and these assets go here. If I don't actually move any assets into the trust, if I just leave them as is, my car, my house, my bank accounts, then the trust is pointless. It can give the court an idea of what I wanted to do, but it doesn't actually do those things. So titling is one of the key things that many people miss as a second step after setting up all of these documents. So it's great to pay the attorney and get that inch-thick stack of documents, but again, there is that follow-up step that you want to make sure that you're taking. So what happens if I don't retitle my assets? A lot of us are familiar with the term probate. Probate is a court process whereby you go before a probate judge, who's a county level judge, and provide a will, provide a trust, provide an estate plan. And what they do at that point is then they have the legal authority to say, these assets go here, these assets go here, these assets go here. Okay. If a trust is set up correctly, if everything is titled correctly, none of this is necessary. So that's one of the biggest things, because when you pass away, your next of kin and your heirs do not want to deal with the hassle of going to court. One of the most recent examples, one of the biggest name examples, is the Aretha Franklin estate. Very big picture. There were a handful of handwritten wills that were left by Miss Franklin, and they were all contradictory. There was no estate plan, and what has come out during the subsequent probate proceedings and some of the trials related to this, to be honest, is that Miss Franklin didn't trust anyone. She didn't want one person to know where everything was. So now this process has dragged out for many, many years. It's taken a lot of the court's time. It's taken a lot of funds to pay everyone involved, accountants, attorneys, etc. And it's just delayed a lot of things for her beneficiaries. So
the other thing I would like to add, Kevin, is, and all of that is public. And so for anyone who's looking to have their family matters kept private, and maybe they're a well-known name in the community, the last thing you want is to go through the probate court system and have your state's dirty laundry aired to the general population to go, should they desire to look up the values of your estate and the specific assets and how those assets will be distributed. So that's another key point for why we'd absolutely want to do everything possible to avoid the probate system.
Exactly. And in Miss Franklin's case, that's exactly what she was trying to avoid. Not only did one person then know where everything was, but unfortunately now the public was involved in every piece of that. So when you're going through the probate process with everything except maybe a very, very, very small estate, you should work with an attorney through the process because they're going to know the ins and outs. They're going to know how to protect you through this process. You'll be required to create an inventory of all of the assets that need to go through this process and pay a fee based on those assets. So the assets that are subject to this would be held in a sole name without a designated beneficiary. So for example, those bank accounts that I failed to move over into my trust, that would be held in my name. Or if I have an IRA without a designated beneficiary. So what happens? So once you petition the court and everything else is in, the court will review the will. Hopefully there's one drafted, but not always, and decide how the assets will be distributed. Now, the courts generally will try to follow the last wishes of the decedent, but sometimes that's not always possible. There can be complex situations where the judge has to make a decision that potentially overrides what your last wishes were. So, assuming there's a will, many wills will contain what's called a pour-over provision. And what that says is that any assets that are held in your sole name, in my name, for example, are then added to the trust and then distributed per the terms of the trust. That's a great thing to have in there. A lot of people will look at that and say, oh, my will takes care of all this. I don't have to go through all that titling. Yes, you do. Because even with that provision in your will, that just tells the judge how you want things to go. That doesn't actually move the assets into the trust. It doesn't actually avoid probate. So titling has been a mantra for Jen and I as we've worked together. We talk with clients about this regularly. One of the examples that I came across recently in the last couple of months is I had a middle-aged 45-ish-year-old client that still had an UTMA account. Basically an account that's set up for a minor child that had been set up by his parents way back in the day, but nothing had ever been updated with that account. So it was still out there with that titling. So those kinds of things are to me, are obvious and should be addressed. So can we avoid probate? Absolutely. So a properly funded trust isn't required for this. So we talked about trust. Trusts are conduits. Trusts are great. But you actually don't need one to avoid probate, but you need to make sure that you're checking all of the boxes, all of them. You want to make sure that all of the assets are either held jointly with a surviving individual, usually your spouse, or held with current transfer on death beneficiaries. So this is actually very common with bank accounts or other financial accounts. You will see, Kevin transfer on death to his son. So when that happens, when you have the accounts titled correctly that way, they will be transferred immediately upon your death to that beneficiary. There's no need for the probate process at that point. Michigan, a TOD beneficiary can even be assigned to your home. So there's a specific type of process for this. A ladybird deed has to be executed and filed with the county. This isn't just paperwork that you keep in your desk drawer for someone to find, 2 weeks after you passed away. This is actually something that needs to be registered just like any other deed does with the county. It's a special type of quitclaim deed, which says that upon my death, I will transfer this home to go to a named beneficiary. So there are other methods of doing this, but the advantage here is that you keep the authority over your home in your lifetime. You can mortgage it, refinance it, rent it, sell the property as you wish. You don't need the beneficiary's permission to do so. So you can also change the beneficiary at any time. All you need to do is prepare a new deed and register that with the county. So there's also no tax consequences on this because there has not been a transfer of ownership. So when you pass away, the beneficiary will receive a step up in basis at the time that you pass, which does help avoid capital gains taxes, or at the very least minimize them. And if the beneficiary is a close relative, here in Michigan at least, property taxes won't be uncapped at death. So, quick question here. What level of net worth would we recommend working with an attorney versus a DIY approach of simply naming beneficiaries on accounts and making sure accounts are payable on debt to individuals? My take on this is that if you've got a smaller estate and it is primarily financial accounts where you can set up these transfer on death provisions, may not need an attorney involved. So it's where you start getting into a more complex situation, like business interests, significant real estate holdings, things like that, that you probably want an attorney involved just to make sure that everything's going to flow through correctly. Jen, what do you think?
I would agree to that. The only caveat would be if you had any beneficiaries that you wanted to leave the assets to, that you wanted to put some type of parameters around. So if you had a child that you were going to leave the funds to, but they had substance abuse issues, or they were in the process of going through a divorce, or any of those kind of life events that Kevin talked about earlier, if we want to safeguard those funds and not just have them go outright to that individual, now we might want a trust, even though the value of that trust might be lower than what someone else might consider necessary. If we want to put parameters, provisions around who can have distributions, when those distributions will occur, that might be a reason to set up a trust, even though the value of the estate might be low.
And I can say that hiring an attorney to set up in a trust is probably not going to be as expensive as you think. And within the big picture, I feel it's worth it in those situations.
Yeah, unfortunately, estate planning is one of those things where it's not a one size fits all. Every estate is different. Every estate plan is different. It all comes down to what are the goals of the individual setting up the estate, and kind of what are the family dynamics and how do they want to go about accomplishing those goals. So everyone's estate plan is going to be different depending on all of those things and the size of their estate. It all kind of factors into the end product.
Jen, would you like to talk about our estate's financial snapshot?
Absolutely. And so whether you're getting ready to visit with your estate planning attorney for the first time, or you're reviewing previously drafted documents, the best place to start in all of this is with developing a personal balance sheet. And so many people, they think of wealth as how much is in my bank account, but really creating a wealth statement is so much more than that. And I know that Kevin touched on this earlier, but your personal wealth statement is going to include not just how much do you have in cash accounts, brokerage accounts, but we're also going to want to look through to say, how much do you have in retirement accounts? What property holdings do you have? Do you own any business interests? Are there any outstanding life insurance policies on either your life or your spouse's life? Do you have any expensive vehicles, a boat, any of those toys that would be significantly valued? All of those assets should be incorporated into a personal net worth statement because they all are incorporated into that total net worth value that's going to be factored in when we decide kind of what trusts are being funded. Are we subject to estate tax? All of those assets need to be factored in. Additionally, we also want to look at any liabilities that you have. Are there any outstanding mortgages on your primary house or your vacation house? Do you have any other loans or lines of credit that are outstanding? Any significant credit card debt that would be out there? Any of those outstanding liabilities should be factored into this as well. And because not all estate plans are equal, like we mentioned, they're all going to be different depending on your wealth and your goals. Some estate planning techniques are going to be better than others. based on, again, those goals and your level of worth. And how do you determine what estate planning strategy is best for you? First, we need to quantify your wealth. So bear with me. I am going to switch. Kevin, did that make the switch over?
It did.
Perfect. And so we are going to switch over to what Maner would use for developing a personal net worth statement for clients. Of course, you could do this on your own, create your own type of template, but these are the things that we feel are important to clients to track during their life and as life progresses when they're developing their estate plan. And so down the side, we see these various rows of different categories of assets. So we've got cash, stocks and bonds, deferred retirement accounts, any corporate interest or flow-through interest, so any partnership interest you might have, single member LLCs, any personal real estate. So this could be both your primary house, a vacation house. If you have any rental properties that you own, that could go in there as well. And any personal assets. So again, those boats, vehicles, RVs, any toys that you would have. And finally, any life insurance. We would want to document that here as well. And then down below, like we discussed, including any debt that you had. So likely we would have at least possibly an outstanding mortgage on an individual's house. Now, creating a net worth statement isn't just about identifying your assets and quantifying them. We also want to look at titling. I know Kevin mentioned how important that is in conversations and in deciding how assets are held and what will happen to those assets after you pass. And so we've got columns across the top for jointly held assets. Those are assets that'll pass automatically by rights of survivorship to that named joint owner when you pass. We've got columns for both the taxpayer's revocable trust and their spouse's revocable trust. How those assets will get passed to the next generation depends on the provisions within that trust document. And then separately, we've got columns for assets that are held both individually by the taxpayer and individually by their spouse. This could include retirement accounts. This could include life insurance. And so we might have assets that end up in these columns where they have beneficiary designations assigned to them that will transfer by right of survivorship in that regard. We absolutely want to document those things on the net worth statement. The reason for that being any assets that end up in these individual columns, so whether it's by the individual or for the spouse, this is an easy way to pinpoint, do we have any areas of our estate that could be subject to probate? And so when you lay out your assets in this way, it's very easy to identify if a potential asset has slipped through the cracks as far as either retitling it or adding a designated beneficiary on that account. And so we recommend for clients to go through this process and one, not only identify what is your net worth, but also start to look through to see, are we subject to probate in any way, or have we safeguarded ourselves and properly titled all of our assets to avoid that process? Again, probate is timely. It's costly. We have to pay both an attorney and a probate inventory fee, and it's public. So if we are doing our jobs as your advisors, we are helping you avoid that probate process. And as Kevin mentioned with your trust itself, this net worth statement is also a living document. So as life happens, we are opening accounts, we are closing accounts. The best practice would be to at least, I would say at least once a year, if not more frequently than that, update this balance sheet. Did we open any new accounts? Have we closed any accounts? Do we need to change beneficiary designations for any of the accounts we have? Oftentimes, I think I had in the recent history, a client passed away he had named his spouse as the beneficiary on his IRA account, and she had named him. They had likely held these accounts for several years, and likely their kids might not have even been born when they initially set up their retirement funds. And when, unfortunately, they both passed in the same year, husband passed first, his account went to spouse, avoided probate. When spouse passed, unfortunately, her only named beneficiary on that retirement account was her deceased husband. And so she had thought, I'm sure during her life, it's set up, my husband is named, there is a beneficiary designated to this account. Unfortunately, because they passed away so close in time to one another, she did not have a chance to update her beneficiary designations to include contingent beneficiaries and name the kids. And so that retirement account, even though there was a named beneficiary, because they were deceased, that account went through the probate process, which was an unexpected consequence for the kids. And so we want to make sure we not only have those primary designations, but let's also make sure the contingent owners for those accounts are who we want them to be and they're up to date. And that would be for marriages, divorces, unfortunate deaths of the children, deaths of your spouses. All of those kind of life events would cause reason to revisit those both beneficiary designations and your estate plan.
Just to emphasize that, I'm sure that Jen and I could take up the rest of the webinar telling specific stories about situations that we've run across in our careers with all of that. So it's very important to make sure that you're revisiting all of that regularly.
Yeah, absolutely. And as Kevin mentioned, you visit an attorney and you go through this process and you get this big stack of papers and you leave their office feeling so accomplished that you've signed your trust and you've completed the estate planning process and you can wipe your hands of it and feel done. And unfortunately, as Kevin mentioned, that's only step one in the process. Step two is often the bigger lift, and that's physically going through and retitling every single asset that doesn't have a designated beneficiary assigned to it, that isn't held jointly with another individual into the name of that trust. It's such an important step. And I think, unfortunately, because it often falls to the individual to accomplish, your attorney can't retitle your bank account for you. Your CPA can't retitle your bank account for you. We can give you touch points and remind you that this needs to happen, but it physically falls on both the taxpayer and their spouse to do that, that sometimes those are the pieces that fall through the cracks and make us subject to probate when we could otherwise avoid it. So to the extent that we can complete a balance sheet, have a good handle on how those assets are titled, who those beneficiary designated individuals are, we are making ourselves more bulletproof to avoiding the probate process. And so how do you know if you need to review your estate plan or if your estate plan is as tax efficient as it could be and you don't need to visit an attorney once again and rehash kind of your goals and plans for your estate and how it will transfer? Step two kind of in this process, step one being developing a balance sheet. Often step two is if you have a current estate plan, generating a flow chart or some easily read diagram for how your estate currently flows and what will happen to those assets and who will inherit them upon the first spouse's passing, upon the second spouse's passing, and what does that look like, assuming that the kids are named as beneficiaries. We recommend that if you have a prior estate plan that you revisit this frequently. You might leave the attorney's office and maybe 1 month later, you already don't remember what that estate plan said, or maybe a year later or 10 years later. Time passes so quickly that we recommend that you get your estate plan out every few years and revisit the terms of that document to ensure it still accomplishes your goals, that the key players involved are still relevant. Are your trustees still the people that you would want administering your trust once you've passed? Are those people still alive? Are they still in your lives? Are they still financially capable of administering and handling those assets? Do you want to change any of your beneficiaries? I know oftentimes I'll work with clients and they'll have their estate plan completed and laid out, and it's a product they feel good about. And we start talking through the terms of the trust, and they find out that their kids, who are, maybe ages 30 or 35, if something was to happen to the parents tomorrow, those kids would inherit all of the funds. And it's a significantly higher amount than the parents had intended, maybe when they wrote that trust document 5-10 years ago. And based on what they know about their kids and their financial decisions, maybe they're not ready for that volume of wealth to fall in their laps. Creating a balance sheet and coupling it with a flow chart to find out when those transactions will hit and to what extent that inheritance will be can really be eye-opening to clients, to spark the need or desire to make adjustments for your estate plan. Attorneys are great at what they do. They are wonderful when it comes to the legal side of setting up a trust or estate, but unfortunately, they don't often have the same financial picture for a client that we would have as a CPA. So even if you're working with an attorney, we recommend having your CPA involved in either those discussions on the front end, or at the very least, reviewing those trust documents before they're signed to make sure, one, are they as tax efficient as they could be based on your level of worth? And two, is it accomplishing your goals in the most tax efficient manner? Again, attorneys are great at what they do, but they don't always think through the estate plan with their tax hat on. And we can easily put together a flow chart that can summarize those provisions and make it easy for you to refer back to at later points and make sure, yes, 1 month later, 1 year later, 10 years later, I feel good about this document and it still accomplishes my goals. And so bear with me 1 second. I'm going to switch over to Kevin. Did that switch on your end?
It did.
Perfect. So I'm going to switch over to a sample flow chart that Maner would put together for clients. Again, this is for illustrative purposes for client John and Jane Smith. In this example, they have a combined net worth of $10 million. That number would come directly from a net worth statement or a personal balance sheet that we would create for them or could be provided. And from there, we'd want to break down and say, how is that $10 million held? So in this case, John owned $1.5 million of assets held jointly with his spouse. He had beneficiary designated assets of about $2 million that will go to Jane when he passes. So that could be either IRA or retirement accounts or life insurance policies. And then he also had irrevocable trust account assets of $4.5 million. So these are assets that during his life, he still owns, but has retitled into the name of his living trust to be distributed based on the terms of that trust once he passes. And then finally, John got fancy and he made a irrevocable life insurance trust while he was alive with a policy that will pay out of about $1 million when he passes. So John owns about $9 million of assets and Jane owns $1 million. So together they have $10 million of assets. When John passes, his estate plan document was set up to fund a family trust to the extent that his lifetime exemption hadn't been utilized. So Kevin will talk a little bit later in the presentation, but currently the lifetime exemption for an individual is about $13 million. Combined, it's about a little higher than $26 million that a married couple can give away during their life or at their passing estate tax-free. And so for John, he had $4.5 million in his revocable living trust. That's well below the $13 million that he's allowed to give away during his life or at his passing. So all $4.5 million of those assets go into a family trust. His marital trust will go unfunded. And so that $4.5 million is held for Jane's benefit during her life, or she can dip into it for specific needs. As far as principal goes, so the physical assets of the trust, she can dip into those for specific reasons. So Jane has $4.5 million available to her through a trust. Separately, she has $1 million of her own assets and $3.5 million of assets that were given to her either through joint ownership or those beneficiary designations. So she's got $4.5 million of assets in her name and another $4.5 million of assets held within the trust. So after some expenses are taken out, she's got about $8.9 million available to her after John passes. Assuming Jane then passes much further into the future. Sorry, my light went off in here. Their kids will each inherit just shy of about $5 million. And so that money will be available to them, my goodness, during their life, at least quarterly, and from a net income standpoint. So if they had mutual funds owned within those trusts, any interest dividends kicked out from those mutual funds would be available to them annually, and they could dip into the principal, so the physical assets of the trust, during their life for things like their health, education, maintenance, support. Then, based on their trust document, the children would receive outright distributions at age 35. And so in taking a 1-inch stack of papers and minimizing it down to a single page flow chart, John and Jane might look at this and say, yep, this is exactly how we want our estate to flow to our kids. We are comfortable with where they are at in their financial snapshots for themselves. They are well-rounded, they're responsible, they can handle $4.5 million at the age of 35. And we might be done. We might revisit this frequently to say, does it need to change based on tax legislation or future changes in goals? But this might be their end plan. Alternatively, John and Jane can look at this and say, our kids are 33 years old. One still lives at home. One doesn't know what they want to be when they grow up. They jump from job to job. There is no way I want $4.5 million falling into their laps if something was to happen to us tomorrow. Looking at a estate plan in this manner, in a simplified form, all in a one-page summary, can really open the eyes for a client and say, no, I need to make revisions here, here, and here, because this does not accomplish my goals from what I thought I had voiced to my attorney. I didn't realize that the provisions were laid out in this manner, and I'd like to make some edits. So I'm going to switch back. And I'm going to pass it over to Kevin to chat about some legislative changes.
So over the last few years, we've talked a lot about the Tax Cuts and Jobs Act of 2017. This is also called the Tax Reform of 2018, the Trump Tax Act. It has a lot of different names that it goes by. One of the biggest things in this context that it did was it changed what we call the gift and estate tax lifetime exemption. So without going into all of the details on this, because that's a 2-hour webinar in itself, essentially, when you pass away, there is what we call an estate tax. So it's a transfer tax on your assets going from you to your beneficiaries. That tax is 40%. So the way this whole tax regime works is that there is what we call a lifetime exemption. So between that post-death transfer and taxable gifts that you give during your lifetime, the IRS exempts about 13 million of that as of 2023. So the Tax Cuts and Jobs Act, back in 2017, that amount was $5 million. The TCJA bumped that up to 10 million, and now over inflation adjustments, it's about 13 million per person, or just under 26 million for a married couple. Now, the problem with this is that TCJA expires at the end of 2025. There are a whole bunch of other issues with that, but in this context, what we're focused on is that that lifetime exemption will drop from 13 to 14 million, depending on the adjustments over the next couple of years, back down to 5 million. There's going to be some adjustments. It's probably going to be closer to 6, but we'll use 5 million for this discussion. So this presents a limited window to take advantage of this to save on future estate tax. The IRS has already issued guidance saying that if there are transfers that occur while this lifetime exemption is higher, that lifetime exemption that's in play at the time affects those transfers. What I just said is a very confusing sentence for a lot of people. So let's break this down. So in our example, we have a taxpayer and a spouse who want to give a $10 million gift to their adult child before the end of 2025. There are a couple of different ways that we can do this. If both the taxpayer and the spouse each give $5 million, then what happens in 2026 is they've used up all of that exemption, that's remaining to them after TCJA expires and the exemption level comes back down. However, if only the taxpayer gives $10 million to this adult child, then they've used up 10 million of their $12 million exemption, 13 million. So when the higher exemption expires, they'll come back down. They'll be at 0 because they've already used up 10 million of a $5 million exemption at that point. But the spouse will still have that $5 million available. Now, why does this make a difference? Well, as I mentioned, the estate tax is 40%. So when the spouse still has this $5 million exemption available for future giving or future transfers, that's a potential savings of $2 million in tax. And all you have to do is pay attention to when you're making these transfers and how. It's a very simple conversation with your CPA who should be forward-looking and paying attention to these things. This is a hot topic in our industry right now as we get closer to the end of TCJA. Over the lifetime of these changes, there's been a lot of speculation that Congress will repeal, adjust, or make other changes, make other significant changes to TCJA, and to date, those haven't really happened. So we need to plan for the law as written at this point, and we might get lucky. There might be changes at the end of 2025 or possibly in 2026, but my crystal ball isn't that accurate that far out. Unfortunately, there's also a major election in between there as well. So there's not much we can do other than plan with the law as it's going to be written. So one of the other big changes that came around, Jen?
So with that exemption expiring, we are getting in front of clients and wanting them first to be aware of what their net worth is. And second, if their net worth is in excess of maybe 10, 12, 13 million, again, exemptions going from 13 million a person down to somewhere between $5 and $6 million a person. So if we've got a married couple, that exemption is going to go from about 26 million down to somewhere between 10 and 12 for them as married individuals. And so for clients who have wealth in excess of this 10 to $12 million number, we're getting in front of clients to say, again, as Kevin mentioned, we have to plan for the fact that this could expire. Legislation could be passed to extend it. Legislation could be passed to increase it, but it's never been as high as it is now. And if we want to take advantage of that inflated exemption amount, we need to do something before the end of 2025. That can be a scary concept for clients who all of their life, they have worked towards building their estate, acquiring assets, accumulating funds, growing their net worth. And now we as their advisors are telling them it's time to give those assets away. They could still be relatively young and feel like I have half my life ahead of me. I'm not ready for this yet. What happens if I need these assets? That can be a hard mind shift to overcome. to want to give assets away during your life and take advantage of these higher exemptions if you don't yet feel, we call it bulletproof. And so one of the things that we are seeing more and more of as we get closer to the end of 2025 is the idea of these spousal lifetime access trusts. And so the abbreviation for it is SLAT. And so what this is, and I'm going to assume in this case, husband sets it up for wife, spouse. But husband can gift assets into an irrevocable trust. So this is a completed gift. Those assets are now outside the husband's estate. He has no ownership of those assets anymore. He has given them into a trust that's irrevocable. He can't undo that decision. And in doing so, has utilized part of his lifetime exclusion, which accomplishes our first goal of using that exclusion before it expires. The benefit of using something like a SLAT is the primary beneficiary of that trust is going to be that husband's spouse. So his wife is the primary beneficiary of that trust and those funds. And should for any reason she ever need those assets during her lifetime, she has the ability to take a distribution and utilize those funds. So that's kind of an easy way for clients to get comfortable with giving away assets during their life by kind of having that safety net that should they need them, it would be available to them. That being said, these are the last set of funds we would ever encourage that spouse to touch. Why is that? We have used her husband's lifetime exemption to get them out of her estate. So we've used this valuable exclusion that we might not have anymore, right? If it comes back down to 5 million, to get those assets out for future estate tax savings. So during her life, if she needs assets, we are first looking to assets she owns personally. We're looking to assets that she and her husband own jointly. We're looking for assets that the husband owns still in his personal name or within his living trust. The last set of assets we want to touch are assets that are now pushed outside of her estate. Because if we start to take distributions, now we're slowly pulling those assets back in and contradicting what we initially did, which was use the exemption to get them out. The other type of trust that we're seeing frequently more and more, and it's the first type of trust we talked about, the SLAT, was an irrevocable trust. Instead, this idea of a marital disclaimer trust is actually provisions that are written into an individual's living trust. And so when we talked through that flow chart that I showed on the screen, John and Jane were married, John passed away, and when he passed, he had this A and B trust that were formed. B was the family trust, A was the marital trust. Based on John and Jane's trust provisions, that family trust was funded first to the extent of his unused exemption, and any assets that he would have owned above and beyond that exemption would have fallen into the marital trust. Both of those trusts, the family and the marital trust, would have received a step up in basis when John passed. Both sets of assets, family and marital trust, were likely available to that surviving spouse during her lifetime. However, the assets in the family trust are outside of the surviving spouse's estate, and they would not get a second step up in basis when that surviving spouse, Jane, passes away. This is a great estate planning tool for clients who have large estates. So for someone who's potentially going to be subject to estate tax in the future, pulling those assets out and having them held within the family trust not only utilizes the exemption of the deceased spouse in getting them in there in the first place, but any appreciation on those assets is also outside of the surviving spouse's estate. And so it's a great way to minimize estate tax when you have a large estate. When you have a smaller, modest size estate that's maybe not so concerned about estate tax, that's where we're seeing, instead of that AB trust format, that marital family trust, we're seeing more of the disclaimer trust written into that living trust document instead. And so what this would say is that when we're going to call it John, when John passed away, Jane is not immediately going to fund that family trust. Instead, she's going to hit the pause button and she's going to work with her advisors to say, what is my current net worth? And am I more concerned about estate tax or income tax in the future? If they have a large estate and estate tax is still an issue, she can fund that family trust and get those assets out of her estate with any appreciation, similar to that AB trust format. However, if their estate is significantly below that lifetime exclusion and maybe the trends for where that lifetime exclusion will be in the future, maybe instead of funding that family trust, Jane wants to inherit those assets just outright and pull them into her personal name. Why would she want to do that? So in this case, their estate is small enough where they're not going to be subject to estate tax in the future. That's not a concern. Instead, Jane is more concerned about income tax benefits. So if Jane chooses to take the assets outright, she not only gets that initial step up in basis when her husband passes, but she'll get a second step up in basis when she passes, meaning that if her kids decide after her death to sell those assets, now we've minimized that capital gain tax on those assets that are sold. It provides more flexibility into a client's plan, and it also allows us that wait and see approach. We don't need to make the decision now whether a family trust is going to be funded. We can almost hit the pause button and decide at the time that the first spouse passes away, what's the bigger benefit? Are we worried about estate tax issues or are we worried about income tax issues? And I know we're pressed on time. We wanted to leave some time at the end for questions, but before we conclude, I wanted to touch on the Secure Act 2.0 and how this is going to potentially affect your retirement accounts and who you've named as beneficiaries. So historically, for non-spousal beneficiaries, so this doesn't apply when you pass away and you leave your IRA to your surviving spouse. This would be on the second spouse's passing when she's leaving her assets to kids, grandkids, family, friends, any of those people who are not spouses. Historically, those beneficiaries were able to stretch out their distributions over their life expectancy. In 2020, the IRS changed that rule, as they do with most things. They wanted ways to get their money quicker. And so now individuals who inherit an IRA who are not a spouse of the decedent have a 10-year window where they need to liquidate out that retirement account. And so by the 10th anniversary of the decedent's death, that account balance needs to be at zero. Of course, when this first passed, there was all kinds of confusion as to whether annual distributions needed to be taken or if that beneficiary could take no distribution in years 1 through 9 and then completely liquidate the account out in year 10. The IRS has since come out with updated guidance stating that the beneficiaries, assuming all of this is if the decedent passed after 2020. So if they passed before 2020, old rules apply. If they passed after January 1st of 2020, they do need to liquidate that account out in 10 years by the 10th anniversary of the decedent's death. And they must start taking an annual distribution from that account. So if you inherited an account from someone who passed in 2020 and didn't take a distribution in 2020, 2021, 2022, or don't plan to take one in 2023, it's okay. The IRS is giving you a free pass. However, starting in 2024, you'll need to take a distribution from that account, and the 10-year window still applies. So now you don't have 10 years from starting in 2024. You've only got maybe 6 or 7 years left to take that distribution out and liquidate the account. I mention this because inheriting retirement accounts aren't as beneficiary favorable as they once were. And so if you have an estate that consists of significant retirement account assets, you may want to work with your advisor to say, are there things I can do now to minimize the amount of tax that my beneficiaries may need to pay in the future? So maybe that's focusing on using those accounts for charitable giving. Maybe it's doing Roth conversions in years when income is low. The answer is going to be different for everyone, but I wanted to bring this to our attention because this was a change in rules that happened in the last few years, and we're constantly getting new guidance from the IRS as to their expectation for how this rule would play out. And so with that, I'm going to turn it back over to Kevin to wrap us up.
So we've got a few questions here in the chat. We'll get to those in just a moment. But the slide deck that will be distributed does have my email address and Jen's, as well as our office phone number. If you have any questions regarding the content that we've provided today, please feel free to reach out. Or if any other questions come up, we'd be happy to help. I also just want to touch base really quick about what we call Maner Wealth. So here at Maner Costerisan, we do have a full service wealth management practice that is integrated in with us. So if you look at the team at Maner Wealth, it consists of CFPs, certified financial planners, CPAs, certified financial analysts. So we have their financial advising experience with Jen's tax experience, as well as several others of us in the firm. Maner Wealth is a registered investment advisor firm, and they act as a fiduciary for all of their clients. Currently, we have around 175 million of assets under management. We're not a small management group there. One of the things that we can offer is what we call our complimentary second opinion. So between Jen and the financial advisors that make up the Maner Wealth team, we'll review your current plan and tell you where there could be room for improvement or not. You might be okay. We're not looking to bring you over from another financial advisor. It's there to give you peace of mind. There's no cost, no obligation, just a different perspective, a fresh perspective. It's a complimentary consultation that you can book through the website at manercpa.com/second opinion. All right, let's go on to questions.
So we have just a few minutes for questions. If we don't get to your question, Sydney is going to provide them to us and we can respond offline with our response. So if we don't get to your question, don't fret, we will follow up offline with our response.
So I think I just see 3 here that we haven't touched on. Do we review trusts that were prepared by another attorney?
Absolutely.
Yes, we are not attorneys, but we can definitely offer a tax perspective on the way the trust is currently written. And if there are any recommendations for you to take back to your attorney, we can definitely do that. Have a trust. How does a ladybird deed fit in? There can be a lot of ways. Jen, would you like to take this one?
Yep. So you can think of a ladybird deed almost as being a beneficiary designation like any other asset. So when you have a retirement account with a named beneficiary assigned, that asset transfers automatically to that beneficiary, separate from any provisions that are written within your trust. A ladybird deed would operate in the same manner. So if you have a ladybird deed on hand and registered, when you pass away, that deed will take effect, much like that transfer on death beneficiary would, and automatically pass to that named person on the deed, outside of what's happening with any of the assets named within your revocable living trust.
All right, from Jeff here, on bank accounts and or mutual funds, is listing a beneficiary the same as putting TOD on the accounts? Generally, yes. You're going to want to double check with your financial institution just to be sure, but I don't think I've seen a situation where it's not. For a Roth IRA that flows to a non-spousal beneficiary, does the beneficiary still need to take annual withdrawals before the 10 years is up? Are there traditional IRA versus Roth IRA rules different for this purpose? Jen?
So the 10-year payout window is applicable to both traditional IRAs and Roth IRAs. Obviously, with the Roth IRA, there's no income tax consequence to the beneficiary that inherits it, but they're still held accountable for that 10-year payout window. Is there more to the question?
I think that covered it.
Okay.
Basically, yep, the 10-year window still applies to Roths.
Yep.
I think that's all of the questions.
Perfect. And we are right at 11:30. So thank you so much to everyone who joined us today. We appreciated the questions and the commentary that you provided. Sydney will send out copies of the presentation after it's concluded. And I can pass it over to her to any last minute housekeeping items, but we appreciate you all attending and thank you so much.
Yes, thank you, Jen. Thank you, Kevin. And thank you everyone for joining us today. So as Jen mentioned, tomorrow, November 1st, we will be emailing out a recording of this presentation along with the slide deck and a link to that complimentary second opinion with our team. Jen and Kevin's contact information will also be in the email. If you have any additional questions, please feel free to reach out to them. And I hope you all have a great rest of your day. Thank you.